and this is the problem with the markets right now, is that it's today we have tariffs, tomorrow we don't have tariffs. It's this tariff today, it's that tariff tomorrow. And so there's no way to price in. And so analysts are kind of all over the board right now trying to figure out how to value the market, which is all that's happening, right? Markets are just repricing right now, trying to figure out what earnings are going to be 12 months from now and 24 months from now. And you can't do that because tariffs are all over the board.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the end of another week for another weekly market recap featuring my good friend, the exigent portfolio manager, Lance Roberts. Lance, how are you?
Well, I've been better. This has been a little bit of a tough week. So, we'll
I know. We
get
see
way
you've
through it.
sold everything behind you and that your usual studio isn't there. Are you recording this from a cardboard box outside on the sidewalk?
Exactly. No, my normal computer crashed this week, and so I had to send it into the shop to get fixed. So I'm running off a temporary laptop that's about 5 years old. So we're
All
gonna see
right.
how this
What
goes today.
that feels sort of appropriate for this week where everybody is just kind of groping around in the dark, trying to figure out where the market's going to go. I used the word exigent to describe you this week, Lance. That means driven by a purposeful urgency.
Okay.
Maybe that describes investors looking for some sort of relief in this market, but it also applies to today's rant if we can get to it. So,
Sure.
lots to talk about. Let's just jump on in. So, I was going to sort of title today's discussion "The Elusive Rally," because folks have been thinking, all right, at some point there's going to be a bottom here. Last week we talked about the
Yep.
potential for a tradable rally. We got one, but it was like a day and a half long. Is that all we're going to get, or what's
Maybe.
going on?
Yeah, well, no, it's been interesting. I mean, really for the last couple of weeks, this market's been trying to rally. We get a rally, we get a sell off, get a rally, get a sell off. Let's go to the charts. And this is just a kind of our weekly kind of chart that we just keep watching. But really for the last, kind of really last 2 weeks, this market's rallied, decline, rally, decline, rally, decline. It's been in an upward trend channel until today, and we broke to the bottom side of that. So that's not a good sign at all. It's something that we obviously have been, hoping wouldn't happen, but it is what it is. And again, there's a couple of things that are going on. You want to be real careful about, when something happens like this for one day is of making an immediate assumptions like, oh my gosh, I got to get out, got to sell everything, that type of thing. There's a lot of things that are happening right now between now and next Tuesday that are having a lot of impacts on the markets. And we'll certainly get into that a little bit more here as well. But, again, kind of the bigger issue, and again, something that's, is certainly worth considering. And again, this is also comes with that kind of typical grain of salt to some degree, because, over the last 15 years, a lot of these indicators like the 50-day, like the 200-day, they have not been as reliable of breakpoints as they were previously because of all these monetary interventions, et cetera. Historically, if you broke the 200-day moving average, that was a great kind of sign to, get out of the markets because you're going to have a bigger correction over a certain period of time. And we've seen these failures before. Same thing with the 50-day crossing below the 200-day moving average. That's typically the death cross. And we've seen those over the last 15 years get reversed very quickly in the markets, frustrating, people thinking that like, I'm going to short the market, make a lot of money. It's been very frustrating for that because the Fed steps in or something happens that causes the market to reverse. Now, again, this time is different as every time is. We don't have potentially a Fed at the ready to come stepping into the markets, although they did just announce, kind of the decline of QT. We talked about that last week. But we did fail at the 200-day moving average. That's certainly not a good bullish sign here. Again, it doesn't mean the markets are about to crash and fall apart, but it does suggest we're probably going to be struggling here for a while longer.
Yeah. Hey, sorry. Let me just
But
interject here. I just want to note for
sure.
folks that we're recording this on Friday morning, so the market still has several hours worth of trading ahead of it.
Yeah.
I just mentioned that because given the markets we've had this week, there's potential that Trump could announce tariff relief in an hour, and this thing could rally and close green. So I just in case the market ends up for the day, I want folks to know that we're not we're not saying
Right.
for sure the market closed down this much on Friday yet.
Yeah, yeah, and that's a great point, because again, that could certainly happen. In fact, there was a headline out just a little bit ago that EU is preparing kind of negotiations for Trump on tariffs because of these new auto tariffs. So, now we're going to see potentially, and this apparently this group of EU countries led by France, and what France is famous for is surrendering. So,
Hey,
we'll see. We'll
hey.
see we'll see what this means for tariffs, come next week.
Yeah,
But
and I want to dive more deeply into this to you in a bit. It's one of the bullet points on my list here. But just to your point about the Fed, its
Mhm.
interventions have kind of made TA not quite as predictive as it's been in the past.
Right.
And you're right, the
Yeah,
Fed is now sitting on its hand a bit more, but it's been replaced with Trump, right? Who is
correct.
interjecting all sorts of non-market changes right, left, and center right now. So that's potentially even that same factor on steroids at this moment in time.
Exactly. Now, like I said, there's a couple other things, the MACD buy signal is still in place. It's at risk right now, but it's at a very low level. So again, even if we have a further decline, it's not likely going to be much deeper. Relative strength improved. It is starting to reverse here because of the sell-off over the last couple of days. But again, that's also at fairly low levels. So again, you're going to get back to oversold levels very, very quickly in this market. So, and as I said, there's several factors happening over the next few days. So first of all, today and Monday are the last 2 days of the quarter, which all pension funds, long-term, ETFs that are target dated, or target dated ETFs, et cetera. Those funds, as well as mutual funds as well, all need to rebalance at the end of the quarter. So again, it's interesting. Today the PCE headline came out on inflation and showed core inflation ticked up a little bit. That's not surprising just because of year-over-year comparisons. But again, that's not really bond friendly, and bonds are doing very well on Friday. So again, and bonds didn't do well the last couple of days when markets were selling off, and there was really no news for that. So again, a lot of this certainly, and bonds had a previously very strong rally. So a lot of this really looks like end of the quarter rebalancing, repositioning, those type of things. So that's going to throw a lot of skews into the data. Then on Tuesday we have, on Tuesday is the 1st of April, which typically you get a lot of buying that comes into the market for the beginning of the month. So you see positioners try to position for the month. April tends to be a stronger month. And then on April 2nd, you have Liberation Day, which we have no idea how that's going to turn out because of what's happening with this negotiation over tariffs. So, any positive tariff news, this market's going to scream higher. Any more negative tariff news, it's going to weigh on markets. But that's really been the challenge here. And again, I've talked about this a lot on the Real Investment Show over the last couple of weeks in particular, is what the markets need is they just need tariff. They need Trump to come to the table and say, look, I'm putting 25% tariffs on everybody. There is no negotiation. This is it. It's done. We're over. Everybody's getting a 25% tariff. If he would do that, markets could price in what that means for earnings. Corporate profits just hit a record high in Q4. They got reported yesterday. So corporations are doing just fine. Even with tariffs, their corporate profits are fine. But if you just come out and say, hey, everybody's getting a 25% tariff or 50% tariff, pick a number, doesn't matter. The markets could then say, okay, I can factor that into what that means for forward earnings. I can look at current valuations based on those forward expectations. Now I can include the tariffs and understand what that is. Now I can justify whether or not prices are cheap or not. And then markets would adjust very quickly. What markets have a really difficult, and this is the problem with the markets right now, is that it's today we have tariffs, tomorrow we don't have tariffs. It's this tariff today, it's that tariff tomorrow. And so there's no way to price in. And so analysts are kind of all over the board right now trying to figure out how to value the market, which is all that's happening, right? Markets are just repricing right now, trying to figure out what earnings are going to be 12 months from now and 24 months from now. And you can't do that because tariffs are all over the board. So again, what markets need is stability. And what the best thing that Trump could do is just come to the table and say, look, I'm done messing around. This is just what tariffs are, and this is how we're going to do it, and be done with it, and then shut up, because that would allow the markets to then adjust for what this is. But now you got auto tariffs, then the next month you got auto parts tariffs coming in May. How do you price all that stuff in? Oh, and then if American automakers try to pass on the tariff to consumers, then he's going to do something to them. That just makes it impossible to value markets in that
Right.
type of
And then if they
environment.
retaliate, he'll retaliate even further. Right. So,
Yeah.
there's yeah. So I guess where I was going with this is do you expect stability, more predictability anytime soon, or really do we just need to gird ourselves for, hey, as best we know, we just got to keep planning for curveballs every day?
I think you just got to keep planning for curveballs. This was our article we wrote back on January the 7th called Curb Your Enthusiasm. And we said, look, this year is going to be a year of volatility. Markets are going to be all over the place. Likely returns are going to be close to zero this year. And that's probably about the way this is going to work out. We'll have this correction. This correction will end. You're going to get a rally back to probably about where we were initially. And then you're going to get another correction because of some other issue with tariffs. And then we're going to rally back at the end of the year to get back about where we were. So, again, I would just expect that that's going to be the type of year that we're going to have, and just kind of gird yourself for that type of volatility. And that's really difficult coming after 2 years of basically no volatility and 20% returns. And this is why investor sentiment is so very negative right now, is because it's like, it's been a great 2 years. And, now the markets are down a little bit and everybody's freaking out, but you just banked 40% returns in 2 years. This little bit of a pullback is just should be expected. B, it's completely normal, but it's having an outsized effect because nobody's used to this type of volatility. And I think this is going to be something we're stuck with all year. And I think by the end of this year, sentiment's going to be really bad. So we'll see what happens.
Well, so this goes to the heart of what we've been talking about, for a good while, which is given the environment that we saw ourselves likely heading into. We talked about how active management was going to become, much more essential to both just preserving wealth, but also making gains. And one of the nefarious parts about this sort of false tranquility that central planner intervention lends to the markets, where the passive trade wins out and you just buy the dip and you just ride it, is once that ends, right? Everybody who's been following it kind of sleepwalks off the cliff, right?
Yeah.
To your point, one of the reasons why sentiment's so low is it was easy. You just turned the magic, gains crank, and man, gains came out, and it was easy. And how could it be any easier than this? And why do I need to work with an advisor? Everybody else is stupid who's not doing what I'm doing, right? And then all of a
Right.
sudden you keep turning the crank and nothing's coming. Turn it harder, nothing's coming, right? You get that period where basically your mind is still committed to the old way of doing things. And you're just like, wait a minute, it kind of reminds me of the old cargo cults. You know what those are? Those are the South Pacific Islands during World
Right.
War II, where the Americans arrived, and for a year or two, the economies of these local islands just exploded, thousands fold, right? And then, the war was over and the soldiers moved on, and the natives were like, well, wait a minute, where are good times here? And so they would
Right.
make like, their images of planes and boats out of like bamboo as sort of like an offering to the military gods. Like, well, if we build these, you'll come back and bring all the food and all the stuff that we like, right? And it
Right.
seems like that's what the market's doing right now. Hey, I'm still doing the same things. I'm crossing my fingers and believing in, the magic that just prices always go up, but they're not. Or I'm buying the dip, but it's not working for me, right?
Right.
So that's the real danger here, is you train people to an artificial reality, and then once real reality intervenes, they just walk straight into the meat grinder.
Yeah. No. And look, and that's just, this, and again, this kind of goes back to, kind of what I was just saying a minute ago, is that I think this year is going to be the year that, and again, look, I can be completely wrong. And, if I am, we'll change everything and we'll go back to, whatever we need to do next. But, the way things are setting up, you take a look at the data, there's no evidence of a recession. A lot of the sell off just that we've had over the last month or two has been, driven by headlines of, oh my gosh, a recession's on the horizon. We're going to have a recession, this recession, that. And there's no evidence of it. I mean, GDP just came in, for the fourth quarter. It's fine. First quarter GDP is going to run close to probably 2% by the time we get to the end of the quarter. Personal income, personal spending were both very, very strong today. So again, there's no evidence that the consumer's slowing down. Personal income was up 8%, 0.8%, and personal spending was up 0.4. So, that's plenty strong to keep the economy going. So there's no real evidence that the economy's, going into a recession. Now, none of the data also suggests that we're about to have this boomer economic growth either. I mean, we're talking about 2%, 1.8% growth probably by the end of the year. That's going to bring down inflation. It's going to work onto a lot of fronts on that disinflationary side. But again, there's nothing recessionary. That is going to impact earnings estimates, and earnings estimates are coming down. We've already seen a pretty sharp decline in first quarter's estimates. Those are down about $6-7. Even 2026 estimates are down about $6 from their peak. So we're starting to see those earnings estimates kind of come back to reality.
Well,
But
a little bit, but
prices,
you think they have a lot further to fall in
well,
2006
yeah,
or
they do have a
26,
lot
right?
further fall, but markets are going to adopt for that, right? They're going to adjust, and they're going to price. They're going to value that, right? So they're going to look forward and say, okay, if earnings are at 220 versus 240, what am I paying, for valuations right now? And again, we always typically overpay for that. So the real question all this comes into is all this data. What do tariffs mean? What does economic growth mean? What does the Fed mean? It all comes down to what this means for earnings and whether or not earnings can get justified for the future. The one thing we haven't seen to any great degree is that even with this decline, yes, earnings estimates are coming down, but they're not coming down dramatically, right? There's not concern by Wall Street analysts about forward earnings. This is very tariff centric right now. This is very short term market driven action because it's not translating into either economic data or earnings revisions just yet. I mean, we are seeing negative earnings revisions. Don't get me wrong, right? We are seeing earnings estimates come down, but they're not collapsing, right? They're just adjusting for an expectation of slower economic growth, not a recession. Well, no, there's that's always the question, right? Is there another shoe to drop? Who knows? And that's why we just have to adjust and kind of adapt for the information as we get. Again, everybody was expecting recession a couple of months ago. Now there's no evidence of recession. Those headlines have gone away. So what happens next? And that's going to be, and that's why we just have to keep adjusting and adapting for the markets. Trying to always kind of tiptoe around expecting a shoe to drop leads you to make bad investment decisions over time because you're always worried about that event. But instead, we just have to deal with the market we have and then make adjustments as we go.
No, totally. But I just want to be clear, I'm understanding you, which is you feel odds are pretty good that forward earnings, 2026 earnings are going to have to be marched down by a pretty material amount, right? So
to return to the natural trend of growth and earnings relative to economic growth, yeah, they've got some work to do. But if it happens gradually, that's okay. The markets will adapt for that. That's the whole point, right? So if earnings gradually come down over time, we'll go from 280 to 260 to 250 slowly over time. And we'll get to the end of that and go, okay, well, here we are, we're in the fourth quarter of 2026 and see companies are beating estimates. We're at 250 and nobody cares about where they came from. So as long as they happen gradually, the markets will adapt for that and will overpay for the valuations as we always do, because now we expect 2027 earnings to be even better and 2028 to be better, right? That's the way markets work inherently. The thing you have to watch for is the event that comes along that all of a sudden analysts go, whoa, it's not going to be 280, it's going to be 240, and they adjust that down dramatically like that. And when you get that really sharp earnings revision because of some economic impact, that's what causes the market to go, okay, wait, I got to reprice everything. And there's this dramatic drop in prices. And we're not seeing that just yet.
Yeah. So that is a risk. It's not a guarantee or, that's going to happen. But basically you would be feeling better about the current malaise we're seeing if you felt that earnings estimates for next year were more fairly priced now. But the fact that they're still,
but they're still elevated. And again, that's why, that's why we keep talking about just, kind of curb your enthusiasm, because this is going to be a rough couple of years probably.
Okay, and I can kudos. I think that was a prescient article that you wrote at the beginning of the year. So I just want to I want to take a little bit of the other side of the argument of something you said earlier, because I think it's the way that the Wall Street is currently interpreting it. So you're saying there's really no signs of recession, and we just got some recent data like personal spending that's strong. So the headlines today that I saw was that core PCE came in higher than expected. zero 0.4 versus 0.3. So you have seen a bunch of comments on X and whatnot that like, all right, inflation's back on the rise, right? Now, I know you're saying, hey, slow your roll, folks. You have all the arguments you've made why you think that economic growth is going to continue to slow and we're going to end the year between 1.8 and 2% and whatnot, right? But right now, the market is kind of running around a bit about inflation concerns. And on the personal spending side, yes, it did come in at 0.4%, but expectations were 0.5%. So right now, there's a lot of, oh my God, stagflation, right? Economy's slowing, inflation's going up, right? Now, you've just come out with a piece, and we talked a
Yeah.
little bit about this last week, saying, hey, this is kind of a misguided, I think you called it a misguided media spin, right? The current stagflation panic.
Right.
Yeah. So I know what you think, but the market right now seems to be thinking something a little bit different, and it's probably just spun up and agitated, and hopefully that calms down over time. But do you want to say anything about that we haven't already talked about?
Well, no, it's just that again, if when you take a look at inflation data, and again, we try to strip. Well, if we take this out, we take this out, we take this out. Now we got higher prices, right? It's like core PCE was up, so we strip out housing. The biggest driver of inflation is housing, which is declining, and real time rents are falling. If you take that out, sure, you got some increase in inflation, but again, you're looking at year-over-year comparisons, and so you've got to be really careful with the math, and then trying to extrapolate that into a trend. And so, yeah, the trend is lower; it's not higher. And so, if you just take a look at the trend of inflation data, CPI, PPI, whatever, it's all trending lower. There's nothing that's hooked till bottom, and now we're starting a new rise. And if something occurs that begins to happen, then yeah, we can say, hey, inflation's coming back. But there's absolutely no evidence of that right now. You take a look at what's happening with the consumer. Delinquency rates are on the rise. Consumer consumption is struggling. People are behind on student loan payments. There's nothing inflationary in that data. And again, when you start trying to pass on tariffs to individuals and increase the prices of stuff they buy, that's going to crimp demand even further. And so that's why tariffs didn't create inflation in Trump's first term, is because again, you have consumer choice. The one thing economists always forget about is consumer choice. And I've got a choice. Either I buy a different good, product, or service that doesn't have a tariff on it, or I just don't buy it at all. And with consumers at the bottom 90% basically only making up about 50% of consumption, there's a limit to how much they can consume. When the top 10% are making up 50% of your consumption, they're only going to buy so much, right? I mean, wealthy consumers, they're not going to go out and just keep buying new planes and new trains and new automobiles every week. There's a limit to what they're going to buy. And so that's all going to translate. If that bottom 50% begins to really ratchet down their spending capability because they simply are running out of money, which is the case, the 50%, the top 10% can't sustain the whole economy. So you're going to get slower rates of economic growth, slower rates of demand, bring prices down. Because again, as a producer of a product, I can only price what the demand is for my product. If the demand for my product declines, I have to reduce the price to sell it. And that's the thing that most economists forget. And then, of course, regarding stagflation, you're using a totally wrong definition of stagflation, which is high inflation, low economic growth, and of course, you have to have high unemployment, which there's no evidence of high unemployment. Jobless claims are still near record lows. So, which is the most real-time data we have in terms of employment. So there's absolutely no criteria that meets the definition of stagflation.
Okay, and I just want to note for folks too, if you want to dig even deeper into the argument for why inflation is likely to continue to trend down this year, I just recorded an interview with Steve Henke, economist Steve Henke. It's going to be coming out the day after this video airs live. But Lance, you'll be glad to know that he thinks CPI will hit the Fed's 2% target this year, and very well could close with a one handle at some point near the end of the year. And folks might remember, Steve has actually really nailed his CPI predictions. He predicted 9% inflation. I think when the Fed was just beginning to hike, it was maybe at like 3 or 4%. And Steve said, this is going to 9, and people thought he was crazy. He then said, hey, it's going to come back down to a little bit below 3, pretty much hit that on the nose too. And to predict all this, he's using the quantity theory of money formula. So it's based very much in the academic formulas for traditional economics. And, whether you like traditional economics or not, he's been very right over the past couple of years using it. And like I said, Lance, for that and a whole bunch of other reasons, he thinks that inflation is not going to be a worry near the end of the year.
Yeah. And let me just, so I wrote this article about stagflation. It's out today on the website. So you've got our Substack at Lance Roberts. The article's posted already for you. But I'll just show you this one chart that because again, this is something I deal with a lot. I get lots of questions about oh my gosh, stagflation's coming, Lance. What are we going to do about stagflation? So this was the period that everybody refers back to as high inflation, high unemployment, and economic growth. And this is nominal GDP. So if I have very high rates of nominal economic growth, then I am going to have higher rates of inflation because, again, supply and demand. Now I had some anomalous shocks that came along, the Iran revolution and the oil embargo that occurred those periods and created these supply shocks that created these spikes in inflation. That created a recession, which led to high unemployment. So this is the period where people refer back to as stagflationary. Now take a look at the period where we are now. Outside of this spike that we had due to the 2020 shutdown of the economy, where you had high unemployment, you had big economic growth, and you had a spike in inflation. There was a period there you could say, okay, we had stagflation, but we have to go back and measure what the definition of stagflation is and set some metrics for it. So most economists don't look at nominal GDP. In order to get the definition of stagflation, you've got to count inflation twice. You've got to count inflation as inflation. Then you have to inflation adjust your GDP growth,
right,
to get the low rate of economic growth. So technically, to quantify stagflation, you've got to count inflation twice. So if we do that, and it's a fair argument, I think it's kind of disingenuous to do that, but if you want to do that, that's fine. So we look at when was GDP, real GDP, below 1%. CPI was above 5%. When CPI is above 5%, historically, you get a recession. And when you get unemployment above 8%, that's when you're in a recession, typically, historically speaking. So you just kind of use some long-term averages for this stuff. So you see those two spikes, 1973 and 1982. Those were the two periods that accounted for stagflation according to that the true definition of stagflation. And those both related to very short term. These all lasted about 6 months. And those were due to those exogenous events of Iran revolution and, of course, the oil embargo. So again, we don't have, outside of that, there's, going back to 1947, this chart only goes back to 1960, but I ran it back to 1947. There's never been a period of stagflation in the U.S. economy, and there's not one now.
All right. And so if those are the defining characteristics, I mean, things would have to change a lot from where they are right now to get into stagflation, right?
Right. And you just don't have the drivers for it. So if we just go back to the very basics of how, and this is why I appreciate Steve Hanke and his work, because he just uses economics, and economics is very simple to understand once you just dig into it a little bit and think about it. The whole economy runs on supply and demand. 70% of GDP is personal consumption. It's what you and I are doing every day in the environment, right? We're going out, we're buying groceries, we're buying gas, we're doing those things. That's what generates the revenues for companies. That's what creates economic growth. When they get revenue coming in, they have a lot more revenue coming in and a lot of demand for whatever product they're making. Well, I've got to make more product. So if I got to make more product, then I've got to go hire some more people. If there's a lot of demand for hiring, then I've got to increase wages to hire employees, because otherwise they'll get a job at another company that's willing to pay more. And so it's this virtuous cycle of the economy. So if you get the reversal, for everybody that's hoping we're going to get a recession, which I really don't understand why people kind of root for a recession, but that's on you. But you root for a recession, that's great. But if the economy is slowing down, people are spending less, that's less demand, which means I start laying off people. And if there's less demand and I've got to sell some product, I've got to start cutting my prices to sell it. So the only way you're going to get stagflation in this environment where we are, and this is why you don't have stagflation historically, because when you get a recession, you get deflation or disinflation at least. Prices are going to come down just because of the way economics work, supply and demand. So you've got to have some exogenous shock that comes through the system that simply shuts off a supply of a product. And again, no, the oil embargo couldn't get oil, right? And so all of a sudden we had this massive surge in oil prices. I grew up in, if you grew up in that period like I did, I remember waiting in line with my dad at the gas station to buy gas for a quarter, right? A quarter a gallon. It was great. My dad was one of the first guys to put a propane tank in the back of his pickup truck. It was this 1967 Dodge pickup truck, step side. You put this propane tank in the back to avoid the gas prices.
Driving around with a big
About
bomb.
3 months later, it was useless, right?
Yeah.
So, other than that, it was a mobile bomb. It was great.
Yeah.
But that's so again, you just go back to the very basics of how the economy works. It's pretty easy to figure out where things are headed based on the data. And the data doesn't suggest higher inflation at all, suggests we're going to have a more disinflationary trend over the next couple of years.
Okay. And just to be clear, and you've already mentioned this in several dimensions, but just the fear that many people have, that I also agree is being written a lot in the media, is tariffs essentially mean constrained supply or, higher prices. And that's going to be that's going to be the inflation part of stagflation.
Well,
Right.
not really. Again, you go back to
No, I know. Elaborate, but that's the narrative playing in a lot of people's heads, right? Yeah.
Right. But again, we go back to just basic. Just talk about you and me as person as people, right? If so, they're going to put tariffs on automobiles, right? So first of all, I already have a car, so I don't need to buy a new one. Maybe I was planning on buying a new car, but I'm not now. I'll just keep the one I've got because it's paid off.
Right. And just to be super clear, Trump is saying, I'm not putting it on US cars. So the thought there is, oh, you'll substitute. You won't buy the foreign car, you'll buy American. Now, that being said, there's lots of components that go into American cars that will be more expensive. So prices of American cars could go up.
Sure. And absolutely. And again, and can I afford an American car? That's the other issue.
Yep.
But again, and there's going to be tariffs on parts coming in May, right? So he's, this is where it gets really convoluted, because if you take a look at a Ford, yeah, it's built in America, but we use a lot of foreign parts. So again, the tariffs are not going to be immune to just U.S. automakers. U.S. automakers aren't going to be immune to tariffs. And then, Trump says, okay, well, if you try to pass on the tariff to consumers, then, wow, we're going to do something to you if you do that. And this doesn't work out well. But back to the very basics of economics, if something goes up in price, either I'll find something cheaper or I just won't buy it. And consumers have that choice. And so again, and when it comes back to General Motors or Ford or anybody else, if I've got a lot of inventory stocked up and people aren't buying cars, then I'm gonna have to cut prices. It's going to eat into my profit margin at some point. The point is the question about the inflation part of inflation is, can I pass the tariff on? If I can't pass the tariff, I have to eat it. Remember, the only people that pay tariffs are producers. They're the only people that pay the tariffs. And the question becomes whether or not I can pass that tariff on to consumers. If I can't pass it on, there is no inflation.
So let me ask this then, because you said a few minutes ago that we're having record corporate profits, which you would think then you would say, okay, well then actually producers probably should be able to absorb a fair amount of the tariffs because they're more flush than they've ever been.
That's right.
Yeah.
Yeah, okay. And no, the corporate profits are doing great. And again, we're seeing this in the data as well. I mean, this is I keep reading these articles and we've had these conversations. But I just read an article this morning talking about how by 2040, I believe the number was 2035, 2040, that basically all but about 10% of jobs in America will be able to be replicated by AI. So what are you going to do for a living? And so, but that's all huge increases. The implementation of AI into businesses, which businesses are ramping this up rapidly, is going to have a dramatic impact on corporate profitability going forward. Because again, if I can reduce labor through AI, that makes me a lot more profitable. If I can produce my product using no human labor, I'm in good shape.
Yeah, we've talked about this. We've said, there's no force greater in commerce and capitalism than corporations desire to replace human capital if it can, because you get rid of all the costs and headaches and messy human factors and lawsuit potentials and OSHA oversight and all that stuff, right? So I think I told you I was talking with Darius Dale at our conference, and he put up this chart. It was a multi-decadal chart, and it was basically showing uh, the historic patterns where either capital was in the driver's seat or labor was in the driver's seat. And obviously, in recent decades, capital has really held the whip hand over labor. And Darius was basically saying we're at an inflection point now where uh, labor may be the pendulum might be swinging back to labor a little bit. And part of this is sort of the election of Trump and prioritizing Main Street over Wall Street and all that stuff, right? But then we talked about the potential for a recession, and I said, I asked him, I said, hey, like, what is what does the future of employment look like in the age of AI? And he had this big sigh, and he said, that's the one thing that keeps me up at night. He's like, I'm really afraid the next big recession, a lot of those jobs won't come back. And he said, look, if we look at this chart I put up, these are historical cycles, and it looks like we're at an inflection point where, again, capital's advantage should start coming down and labor should start coming up. But he's like, given AI, my fear is that we could actually just see the capital one just shoot the moon now, where literally it just doesn't need labor anymore. And it gets, to become ferociously profitable by employing fewer and fewer people. And he's just like, that's great for companies. I think it's probably leads to Lord of the Flies at some point. He didn't use those terms. I'm extrapolating, but it is a big unknown. We'll put it that way.
Yeah. No, and look, and this has got huge implications for investing as well. I mean, if you take a look at the stock market today, we've gone from 8,000 companies at the turn of the century to 4,000 in kind of the overall market, publicly traded companies of any size. Now we're talking about non-peak sheet companies, right? But we've gone from 8,000 to 4,000 companies in the US, or publicly traded equities in the US. And with the adoption of AI, about, probably in the next 10 to 15 years, probably only about 10 to 15% of all those companies are going to have successfully adopted AI to a degree where their businesses are operating extremely profitably, and they're going to basically absorb a lot of this. So, to see in the future the number of companies shrink in the index from 4,000 to 1,500 to 2,000 wouldn't really that be all that surprising, just as AI just starts to try to just basically starts eliminating the need for a lot of these companies to actually be public anymore. So again, we'll see how this works out, but the trend of where we're headed, employment wise and productivity wise, et cetera, it's not on a trajectory that's going to cure that 90% of the market being owned by the top 10% of income earners.
No,
that's going to get worse.
Right. It's going to be top 10 owned by, or top 90+% owned by the top 1%, 2%.
Yeah.
Yeah.
Unfortunately.
Yeah. Well, we could get distracted on this for the whole rest of this conversation, every other one we have. But back to my point I've been making, there is a real concern that America is switching into, or maybe already has, into an aristocracy from a meritocracy. But hopefully we're able to retard that going forward. But I don't know. It's a big question. All right. So a lot of other things I want to dig through with you in here, Lance. All right. Well, look, we talked about how the market's on its heels right now just because there's just so much unpredictability, right? The situation is just changing on a daily basis, hourly basis sometimes. So I want to put two big questions to you. And I guess the first one is here's the question. How is all this disruption not going to lead to a recession or to a deeper market correction from here, right? And one of the questions being raised is, we have all these curveballs, as we mentioned, coming in. I understand. I've actually been listening to the new administration's economic team pretty closely. And one of the benefits of that team is they're in front of the cameras all the time. So, to the extent they're sharing what they're actually thinking, we have a pretty good real-time sense of what they're trying to do. So, like, are we just having the hard conversations with our allies and saying, look, I love you. I want to, this relationship is important to me, but it's a give and take. And I feel like I've been given way more than you've been taking. And are we just right sizing these relationships and going through the necessary awkward couples therapy? Or, are we burning our alliances here? And I think you can have a debate on both sides of this, right?
Sure.
My point is it's just a tremendous amount of uncertainty here, and it's unlikely to get tidied up, anytime really soon. So you're going to have this increased, uncertainty, and probably in a lot of cases increased concern that, oh my God, this guy just retaliated and that guy just retaliated. Um, Make the case that that doesn't actually create so much uncertainty that markets don't sell off further, negative wealth effect begins to kick in, companies tighten, people tighten, spending tightens, and then the whole thing just keeps building on itself.
I can't make the case that's not. I can't make the case that's not going to be the case, because it absolutely could. Again, that's the economy is slowing down. There's, like I said earlier, there's no sign of a recession yet, right? I mean, the data, we're all working on lagging data, unfortunately, but the data is not suggestive. Personal income and spending today, et cetera, that's lagging. That was from last month. So, we're, right now, it's certainly showing signs of slowing down, but it's not recessionary, but that doesn't mean it can't change. And, if consumer sentiments continues to reverse like it has been, we start getting a contraction in spending, which is very possible. You take a look at what's happening with the consumers across the board, that risk is not outsized at all. That we could see a contraction in spending. If you have a contraction in spending, you're going to have a contraction in the economy. So there is the risk of a recession is not zero. I wrote about that back in January, February this year. I wrote an article that said risk of recession isn't zero. That case that we made then is still very valid, if not more valid now, because the more of a correction you get in the markets, again, consumers are sensitive to that, even though they may not have a ton of money invested in the markets in their 401k plan at work or whatever it is, which isn't, it's only about 25% of employees. But those people see that and they go, man, I'm losing money over there, and I'm concerned about my job, potentially, may or may not have one. I'm going to maybe cut back on spending. And again, if I cut back on spending, then that's going to start to weigh on earnings for companies. You're going to see more companies like Walmart and Target and Costco and these other companies have come out recently. The retailers just all reported, and they were all saying the same thing. Consumer demand is slowing down. We're starting to see weakness in some lines of our products. We're seeing a slowdown in traffic. Online shopping has been stagnant or whatever. So we've seen a lot of those concerns coming from retailers, and that's certainly not something that you should just gloss over and not pay attention to, because yes, the markets aren't going to go straight down, right? And this is the big thing about corrections and ultimately bear markets. They don't happen all at once unless you have some type of financial event, right? You got to have a Lehman moment, or you got to have a shutdown of the economy. But it doesn't mean that by the end of this year, by the time we get into August, we're not down 20% on the markets in total, from the peak. But somewhere in there, you have a rally, and then, then you're gonna get some more selling as more concerns and more negative economic data comes up, and you get another leg of the decline. It's going to, happen in stages. So the market's going to give you opportunities to work yourself out of your positions, reposition your portfolio, et cetera. But yeah, there's certainly the risk of recession is certainly not zero.
Okay. All right. I'm going to go through one or two other kind of big concerns, and then there's a few things that are on the optimistic side I'm going to put in. But overall, yeah, I think you're saying, Lance, hey, look, we had two really good years that were probably too good,
Yeah.
And we got to understand, A, that there's just natural mean reversion, but B, there's just a lot of things going on here right now that a prudent person shouldn't ignore in their positioning strategy.
Right.
Okay, so we've got the potential of what you're talking about, and just to make your point about the Lehman moment, you can't really predict those things, but the more stress that comes on a system, the more likely a Lehman moment is to happen, right? more stress you put on their things, eventually the weaker, more exposed people break. Not saying that's a guarantee, just saying the odds go up, right?
Yeah.
So one of the
Again,
things, sorry, go
I
ahead.
was just saying real quick though, the Lehman moment didn't happen in isolation. It wasn't like the markets were just fine and then there was the Lehman moment. The markets were already correcting for months ahead of time. Remember, we had Bear Stearns back in March.
Right, but that's my
And the
point.
markets rallied back
That's
to
my point.
all-time
The
highs.
stress was building, and then finally, right, something
Well,
big.
no, and then so you had Bear Stearns fail in
Yep.
March of 2007, 8, right? And then the markets rallied back to all-time highs, and then they started selling off again, and we created a nice head and shoulders pattern in the markets in April, May, and June. And then in June, you broke that neckline, rallied back to the bottom of the neckline in July, which gave you a great exit point to get out of the markets. And then the markets rolled over, started coming down, and started selling off again. Mildly, we're having this type of correction in July, August, early September. And the reason I know all this is because I was sitting in an apartment. I just sold my house, and I'm like, okay, got to close on my house. So me and my wife are gonna buy my new house. It'll be great. And I'm sitting in the house Friday, September the 18th, and then the headline comes across, Lehman goes into bankruptcy. And then, the proverbial, hits the fan on Monday morning. And for the next 5 days, the markets are shut down. Washington Mutual fails, the whole 9 yards happens. And then the market, really drops sharply,
Right.
After that period. But you had plenty of warning that there's something going wrong in the system to allow you to gotten out. Same thing during the dot-com crisis, right? The dot-com crisis didn't happen all at once. You had multiple opportunities in the markets to get out. And that's why, we're always careful about, when you're in the middle of a correction, this is when you feel like man, this market's just killing me. I got to do something. You don't have to do anything. Wait for the markets to give you an opportunity to do something. This market rallied over the last couple of weeks, you had that opportunity there. You're going to get another rally here in the next day, 2 weeks, whatever. You'll get another rally. Use that as an opportunity. If you need to rebalance risks, you've got too much leverage, etc. You're trading options, whatever. You'll get an option to work out of some positions at a little bit better price. Whenever you feel like you need to do something, that's generally the worst time to do something.
Time to do it. Yeah. When you're, as we say all the time, when your emotions are really driving you to do something, it's probably the worst instinct at the worst moment for you. Yeah. And you have said, you've been consistent the past couple of months saying, hey, where this is a market probably where you want to, buy the dips and sell the rips. Buy the dip hasn't been working so much right now, but certainly sell the rips. Like, hey, once you get back into good territory, start taking some off the table, lightening your positioning. Okay, so we have these concerns that you just mentioned, right? Slowing economy, risk of recession, not zero. On the other side, people are saying, hey, look, the new administration, it's really trying to be, pro growth. If we can hang in long enough, we'll see the benefits of that. That very well may prove true. We'll see. But in the interim, we've got DOGE in there, and they're trying to, get the deficit under control, and there's a lot of good that's going on. Hopefully, that we'll start seeing in the shorter term. Article just came out, and let me see if I can share this screen here. In February, the U.S. budget deficit came out, and it was bigger than all tax revenue. So the question that's being raised is by Zero Hedge here is, can we just stop pretending that this is ever going to be fixed, right? That this problem is just getting so big, and tied to this is two things. Let's see here.
Wait. Go back to that chart real quick.
Yep.
Because this is so critically important. You got a calculator handy?
I pulled up my phone, so go for
it. So if you start calculating Social Security, income security, healthcare, Medicare, which is all your prescription drug benefits from the Obamacare, Affordable Care Act, situation, etc., and net interest, add those up, and then look at how much you got in total net receipts. That's your problem.
I got 460 billion.
That's your problem. And so,
and that's not even defense.
Right.
Or veteran benefits.
And see, the national defense. Sorry, you have to include veterans benefits and services. Those are mandatory spending.
Yeah.
So the
491 now. So almost 500 billion.
Yeah. So the only thing you can cut is national defense education, transportation, and other. That's the only spending you're allowed to cut. Everything else is mandatory. It has to be paid. So no, the answer is you're never going to fix that problem unless you either drastically increase revenues or you really start reforming Social Security, income security, et cetera. And again, I don't know how much waste, fraud, and abuse is in there. I'm sure there's some.
Right. And
I'm
that's what
sure
DOGE
that,
would say is, hey, that's what we're going to try to tackle first, is just money being spent that shouldn't be spent. Yeah.
right. But I don't know how much that is. Is that 10 billion? Is it 100 billion? Is it a
Right.
trillion? I mean, I have no idea what that
But
is.
let's assume it's 100 billion, right?
It's still the
You're still at 400 billion, right?
again, this is the problem that we have. And no, you're not going to fix that. And no, we're not going to get, back to a point where we have a positive deficit. And again, you don't want a positive deficit. If you want a recession, reverse the deficit. The deficit has accounted for almost the entirety of our economic growth over the last 15, 20 years.
Right. But of course, that's the unsustainability part of it, right? You can't do that forever. So okay, so DOGE is basically trying to make a difference, but to the finger to the wind math here, right? It just looks like it just could be too little, right? Just trying to empty the ocean with a teacup here. Look, I wish them the best, but just we want to be eyes wide open about the scope of the challenge here. Shoot, I didn't mean to turn off that share, so let me just get back here. So yeah, just to be clear too, our look at this. We've had the worst start to the year on record for the budget deficit so far. And
Right.
again, this is with trying to start to pump the brakes, and yet still.
Yeah. And but see, so
A
this
lot of that's
again,
baked in the
right
cake,
here,
though. Yeah.
right. But this again, right here, this is bad data, so to speak. Because you're saying, okay, this is the worst start of the year on record. We're about to collect taxes, right? So yeah, we're running a deficit now, but we're about to collect income taxes on April the 15th, right? So it's all about how the deficit is how much revenue you have versus your spending, right? And so, so you've always got to keep this stuff into context
Yeah,
when,
but
yes,
we collected taxes all these other years too.
sure,
This
sure,
is the
sure,
same
absolutely.
apples to apples. Yeah.
Right. And so again, that number is probably going to, I'm not saying it is, but I'm just saying that probably the deficit is not going to wind up looking like that by the time that we get further into this year, once we start collecting revenue. We'll see. I mean,
We'll see.
again,
We'll see. I hope
yeah,
you're right, but just on an apples to apples first couple of months of the fiscal year,
yeah.
where it's the worst it's been.
You're just making a huge extrapolation, and I'm not a fan of extrapolating.
Okay. All right. Well, sort of similar. All
That's
right. This
another
is
one.
where
This one. I'm so glad you brought this up because this is my biggest pet peeve on the planet. The CBO is never right.
they're never right.
2000, they predicted that by 2010, we'd be running $1 trillion surplus. We ran $1 trillion deficit.
Well,
They're
I was
only
going to
off by
say
$2 trillion.
they're off, but they're off by, are they off by being too optimistic or too pessimistic?
They're all there. See, this is the problem. I just said, I'm not a fan of extrapolation. And this is all that CBO does. That line, that projected line, is an extrapolation based on current events. And it's suggesting that nothing's ever going to change in the future, and things are going to change all the time. That deficit, the percentage of debt to GDP may be higher than that. It could be a lot lower. If we start getting into a period of time where we have really strong economic growth, let's just say all these policies that Trump has put into place leads to really strong economic growth like he's hoping. Well, all of a sudden, your debt to GDP level comes back down because you got stronger economic growth and you got debt issuance. You're also collecting more revenue, which means you don't have to issue as much debt. So the problem with always extrapolating this is the problem with housing sales and everything else. We take a number and we say, if this is the number, and we're going to get that every month for the next 12 months or next 10 years, whatever it is, that's where we're going to be. And it's like, oh my gosh, that's great, or it's terrible, or whatever it is. Life doesn't, the economy doesn't work that way. So extrapolating is the worst way to make projections.
Well, but look, when you got to make projections, right? You can't just close your eyes in the future. You got to take a guess. These people get paid to take a guess. Obviously, they're not going to nail it. And to your point, their previous forecasts have been, in general, quite under where these numbers have been, at least in terms of debt levels and debt to GDP. So here's the quote here. Where it gets really scary is the CBO's update of what's arguably the scariest chart in the world, that of US public debt, which is now seen rising alarmingly to 156% of GDP in 2055 from a little over 100 or 100 in 2025. So to your point, Lance, who knows what the future is going to bring, but what this is basically saying is looking at the current debt trends and whatnot, deficit spending, this number just gets bonkers the further we go on here. And they know that AI is coming, right? They know that DOGE is underway. They know that they have a sense of what Trump's policies are. I don't know how much they impact the model, but clearly they're not impacting this much at all. But even if they weren't in here, this really says why we need to do something, right? Because if we don't, we're just buried under debt.
No, that's the whole point, is that, like, for instance, look, in 2000, right? So there's the 2000, 2009 financial crisis, right? So go back to 2005. In 2005, we were running about 25% of debt to GDP. And the CBO said in 10 years, we'll be running $1 trillion surplus. Well, so they never right. So they never predicted the financial crisis. They didn't predict the coronavirus pandemic, but take a look at their data. They're taking the trend of growth in the debt and the deficit as a percent of GDP and just extrapolating out. That's why it's a straight freaking lie. And that's wrong. That is not the way that this is going to work out. Just like going back in World War II, you could have taken World War II debt back over there and said, well, over the next 10 years, this is going to keep going up. We're going to be at 200% of debt to GDP by 1975.
And they probably did, but they said, look, we got to do things to grow the economy and get expenses under control. And that's what happened.
They didn't say shit back then because they weren't even running around at that point back in World War II. See, all of this stuff pre-CBO is actual. They weren't making projections back then. And the problem with
saying, if you were back
is
here,
they don't take changes to congressional spending. They don't take changes to mandatory changes in spending. They don't take any of that stuff into account. They simply just extract data.
Okay. I'm not sure. I'm not sure we're really fighting over the right thing here, which is my point is this basically says if we don't make some big changes to the things that you just listed, right?
Yep.
Either congressional spending or we find a way to really get the economy growing a lot faster than it is, right? I mean, those are basically our two big levers here, right? This is kind of the future we have ahead of us, right? Just in the fact how debt compounds and if we don't get our spending ratios under control.
Well, no, if you want to fix that problem, get back on a budget and get off of continuing resolutions.
Yeah, but that's a massive change to our current behavior, right? Like, I'm for it. I think we need to do it, but it's basically saying and maybe it explains why, Trump has amassed this team around him that says, look, we're doing this because we've looked at the data and we're super scared. But when I think about guys like Scott Bessent, right, or even Musk, who have said, hey, this is the reason why I got involved. I looked at the trajectory of the debt and the deficits, and I realized if we didn't do this, we may have a bankrupt country in the future because it's going to be drowned under its debt loads. That's the whole point of this, is basically what I'm trying to bring up here.
My whole point, though, is and look, and your source for this data is the worst, place for investors to go, which is Zero Hedge. Because it just simply.
Oh, I thought you were going to say the CBO.
But again, all of the commentary they put around this, right, is just bear porn. So it's just to scare people into doing stuff. But the issue is there's nothing wrong with this data, right? It's how it's put out in context, and people's like, oh my gosh, we're all going to go bankrupt and die. It's just saying debt increases in relation to GDP. That assumes that GDP doesn't grow from 2%, right? Again, this always has to be put back into context. Where is GDP growth going to be, right? Where's the population growth going to be? And by the way, there's a huge impact of demographics that isn't calculated into this. Because
which
as
would make
the
it
population
worse.
of the U.S. declines, debt issuance won't need to be as much either.
Well, GDP could potentially go down too because we have fewer workers and
Right, but don't worry, AI is going to fix all that. We won't need any workers, but you won't have to issue as much debt with AI, right? So, being facetious. But my point is I just want people to be very careful, because when you read this type of stuff, this is where people get all emotional. It's like, oh my gosh, I need to do this or that because of this. you're not even going to, most of you people that are listening to this podcast right now probably won't even be alive by 2055. So, you
Well,
know,
so
if,
okay, and we're probably going to disagree about this then
yeah,
too. But like, look, what I'm trying to say with these past couple of charts are,
Mhm.
look, there are real problems, right?
Sure they are.
That we need to take like really, you know, transformative change. We got to grab it with both hands and say, look, we got to behave
Okay.
differently if we don't want to live in this.
I don't disagree with you at all.
I, I
100%. I
know.
agree with you.
I,
So
I,
right
I,
now,
I,
but here's the problem, right? Trump's trying to do that. We've got, so whether or not you agree with Elon Musk and Scott Bessent and what they're trying to do in terms of finding waste, fraud, and abuse in government, you got every Democratic judge around the country trying to stop them, filing injunctions, stopping the, you can't get access to this data. Don't do this. Don't do this. You got to hire all these people back. I'm trying to cut the spending, which is what everybody wants. Everybody's telling me they want the deficit down. They want me to cut spending, but you don't want me to fire anybody and you don't want me to stop waste, fraud, and abuse.
I
So
look,
what do you want?
look, I get it. Let me connect my dots because we're
Okay.
not in disagreement on much here. So
Got me all fired up. Damn it.
you
Friday.
know, again, the scope of the problem is massive. The amount of change that's going to be required is massive. We have a new administration that is giving at least some people hope that, hey, we're starting to trying to address the problem, right? But we just put up some numbers that said the problem might be much bigger, at least in the near to midterm, than these guys' ability to really change the needle much, right? Then you add on top of that the blowback, against their efforts by the establishment, right?
Mhm.
So basically, it's just look, big problem, and we even if we want to get a cavalry to try to ride to the rescue, it may not get there in time because of all this stuff, right? And your point was like, hey, that's yeah, but a lot of people take that and they freak out, and what can they really do about it anyways? Here's a point where we might disagree. Um, there is a conversation that we need to have, Lance. So gold. Um, I listened to you closely,
Mhm.
and you have acknowledged that gold has done well, and that
Yeah.
in your opinion, probably so well, it's probably gotten overbought, and that very well could be true. But I think for much of the past quarter or two, if I've heard you correctly, you were sort of saying, and I got it, hey, it's a speculative market and every correlations have gone to one and
Yep.
Bitcoin's gone up too and gold's gone up and meme stocks have gone up, whatever, right? And it's kind of caught up in that. But now the speculation is starting to ebb here, right? With the correction that we've been having in the market and the sentiment going, all the fear and all that stuff, right? But gold has continued to kind of go off to the races. And the day we're talking, it's hitting a new all-time high. I haven't
Right.
checked it in the past couple of minutes, but it's gold futures at least are above 3,100 an ounce, at least as of 20 minutes ago.
No, absolutely. And
So
that, a lot of it has to do with tariffs, right? We've got a lot of importation of gold to get ahead of tariffs, a lot of buying of gold right now to get ahead of tariffs. So, yeah, you've got some influences right now that are certainly, you know, producing the price, pushing the price of gold higher. And that's all speculative. Remember that the only thing that trades the price of gold is commodity futures on the NYMEX, right? That's what moves the price. So if gold traders are trading the commodity price, that's going to push the price of gold up. So if I'm importing a lot of gold right now or I'm purchasing a lot of gold right now to get ahead of tariffs because I'm buying it from a foreign source, that's going to push the price higher, right?
great.
Especially if
Okay.
I'm doing it. And then, of course, as the price goes up, that drives speculators to take on more positions on the NYMEX on the long side, which drives the price even higher. So you've got a very nice speculative cycle behind gold. And look, we have as you know, we have a portfolio that's long gold, and it's doing very, very well this year, right? That portfolio is doing well relative to this correctional market. That's going to change ultimately. So once we get past narratives and once we get past the tariff issues, et cetera, then the fundamentals are going to kick back in. And the last time that you were this overbought on gold, there's only been 3 other times in history. You went through very, very long periods of consolidation in the price. Doesn't mean, you had huge declines, but you went through multi-year periods where gold just basically did nothing. And that's okay. There's nothing wrong with that at all. It's just,
I don't
you
think
need
gold
to be aware
investors
of that.
would complain too much about that given the run. Yeah. But so let me ask you this. So the question which you've started answering is what message is gold sending here given its strength in this current market right now. And I just heard you say, well, it could be a very short-term message of just people trying to get ahead of tariffs, and it's more in speculative people starting to chase it, as you said. That could be it. My question to you is that all of it, or is part of this the people, the world, Wall Street beginning to really look at some of the things that we just looked at, right? And saying, you know
No,
what, in that type of future, you got to have something that is going to give you some sort of protection against, you know,
no.
purchasing
Well,
power
because
devaluation.
no, not at all. Because again, remember back in 2022, gold did not perform well at all, even though we had inflation raging, right? So
Well,
it
wait
was
a
supposed to be
second.
this inflation hedge,
Yeah,
and
but it didn't do terribly. It was one of the better assets. It was off just a little versus 20% in stocks and
but it
bonds.
did not keep up with the pace of inflation, which is the
It,
narrative, right? So
yeah, okay.
we're talking about narratives. And so remember, as human beings, we have to assign a reason for why something's going on. So what you're trying to do is say, oh, I've got this massive debt problem, and that's why gold's going up. That's just the narrative, right? That's how we rationalize. I just wrote an
Sure.
article about
And
this
to
and
be
didn't
clear,
mean to lie.
gold people have been saying that for decades, so that's not a
Sure,
new
sure. And
narrative.
there's extremely long periods where gold was a terrible performing asset. And then there's
Mhm.
periods where it does really, really great. We're in one of those periods where it really does really, really great. And that's fantastic. It's just like stocks or any other asset. Going back to 1950, and just as a point of your narrative, right? So let's just go back to 1970. And so since 1970, we've had raging inflation during the 70s. We've had increases in debts and deficits. We've been increasing the debt since 1980, been running a deficit that's been growing larger and larger and larger since 1980. What was a better performing, if you're going to invest your dollars, right, into an asset that was going to protect the future purchasing power parity of your dollars, what was the better asset, stocks or gold?
Yeah,
Stocks
stocks
creamed it, ham down,
probably
right?
did. Yeah, I wouldn't mind looking at that chart again now after the past couple of years, but yes.
Yeah. But I can find it here. Is just we'll take a break here in a second.
Yeah,
I'll
or
find
we'll
the
pull it
chart
up
for you.
next week.
Yeah, yeah.
Folks, we'll pull it up at some point. Yeah.
Yeah. So, but the point is that, so yeah, but since 2000, right, gold has outperformed stocks
Yeah.
because stocks went through basically a 15-year bear market, and gold was doing well during that bear market period. Gold did well. So, as with all assets, it all depends on when you own them, but we're always trying to assign a narrative as to why. And the gold bubble that's going on right now, that will eventually end, and then money will rotate somewhere else. Maybe it's emerging markets, maybe it's back to US stocks, maybe it's fixed income. I have no idea. But eventually this cycle, just like in the stock market, right? Everybody's suggesting that we're going to go through another major bear market, valuation wise, in stocks, just like we did during the 2000s, just like we did back in the during the Depression era, and just like we did in the 60s and 70s. Went through a very long period with stocks. We went through a secular bear market period. That's going to happen with stocks. That will happen, and it happens in gold. You have these secular bear market periods in gold. And that goes with every asset class. It doesn't matter what it is. Everything goes through these secular periods. And so when we get to the end of this period, then you'll have to figure out what else to do with your money. But right now, it's fine.
Okay. And look, I know last week we pulled up SimpleVisor and you showed the quadrants, and the gold was the one way in the, overbought quadrant here. So look, could it have a sell-off here? Should it have a sell-off here given how far it's come? Probably. Um, uh, so let me trying to pick which question, but let me pull this one. So um, if you think that gold, is in an uptrend and may not even, I mean, sure, it could sell off, but if it doesn't, it could just kind of hang out here for a while, right? It could just trade sideways for a good long time.
Mhm.
Um, the mining companies had really underperformed the metal
Right.
until recently. They're now starting to outperform, but they haven't caught up by any stretch. And even if gold were just to hang out here, I mean, the price of the metal has moved so far, so relatively quickly, that the profit margins on these companies,
Should be
mathematically
huge.
should start being great, right? Yeah. I
But
mean,
you would think so, but the problem is that as the price of the metal goes up, so does all the input prices of everything they use to mine with.
but on a one-to-one basis?
To a large degree, and furthermore, gold miners are terrible allocators of capital
They
historically.
they have been
They're
no
terrible
argument there.
operators. But yeah. And so and that's kind of, and again, this is just kind of where you got to be careful. And when the old saying is you buy the picks and shovels. Don't buy the gold, buy the guys selling the picks and shovels to the miners, right? And so you go buy the gold miners and that stuff. The
Hey,
problem
let
is
me just mention this so you can address it in your answer. So part of why I'm digging on this is I get questions when we talk about gold, like, why does Lance hate gold so much, and why is he so down on the whole sector? So just in your answer, address that. Just put your clear biases, if there are any out there, on this.
Oh no, and that's a total misconception, because I don't hate gold at all. It's just, it's an asset, it's an investable asset, and I trade it as an investable asset, and I'm happy. Like I said, we own it in a portfolio, and we'll continue owning that for a while, and because that particular portfolio has a very specific reason. But here, just as we were talking, I look at assets as to where am I going to get. I have a job as an investor, which is to take my clients' money and invest it in areas that are going to give me the best rate of return over time. And so this is what this chart shows you. This is performance. This goes back to 2011. So since 2011, where was the best places to be owning capital? Because this is a question I get all the time, is like, why don't we own international and emerging markets? Because they've been terrible performers over time. So why do I want to have my money invested in assets that underperform rest of markets? So the green line is the NASDAQ, obviously, hands down. If I invested in that, I'm doing the best. The black line is the S&P 500. Everything else below that is starting to run down. Basically, emerging markets, international markets, gold is down here. It's
the yellow line, yeah, right there.
But as you just kind of go down, small caps, mid caps, they're all just massively underperforming. There's moments that these particular assets have an outperformance, and the reason we own gold in that one portfolio is because when we built that portfolio back in 2022, gold was beginning to show signs of outperformance. So we added to the position in that, and we managed that position over time. So.
And sorry, is it just the metal exposure in your portfolio, or do you have miners as well?
I have no miners, because again, miners are terrible performers historically. Okay. Again, you get little bouts of outperformance, but the fundamentals in those companies, it's very hard to justify owning them.
Yeah. So, and just to be super clear, when I talk to folks about this, I say either just try to go for the beta, understanding you're going to have the dogs in there too, right? Or find somebody that just does nothing but track this sector and has a good track record of picking the the jewels from the stinkers, and leverage their expertise. Because otherwise, there are it's almost like the inverse VC model where you have so many stinkers, they just, no matter what gains you have, they just eat them up. Yeah.
Yeah, and that's the thing, is like, what I'm trying to do is I'm trying to create a return over time, create cash flow. And the other problem with gold is it has no dividend, it has no fundamentals. So you can't value it other than you've got to tie it to a narrative, right? So the only, and that's not really creating a fundamental structure for it. It's like, oh, it's the debt. Well, maybe it's correlated to the debt today, but if it's not correlated to the debt tomorrow, then what's your argument going to be? 2022 wasn't correlated to inflation, but so that's why those narratives fail. And again, that's where you got to come back to what moves the price of a commodity. And gold is the same as oil. It's the same as corn. It's the same as wheat. It's the same as any cotton. It's simply, what are the buyers and sellers doing on the NYMEX in terms of the futures contracts, moving that price up and down. And if there's ever a point here to where we start to see a reversal in that trend of those commodity traders, there's, and it's quite fascinating too, because people look at AI stocks or whatever and say, oh, those are massively overvalued relative to this, that, or other thing. The only thing you've got to measure gold with is the technicals, and those deviations from long-term means are at massive extremes. You are going to revert those prices. The law of reversions is not repealed for gold.
Right. Yep.
And that's very true. That is, that reversional process, whenever it occurs, and again, it could be next month, it could be 5 years from now. So again, you've got to be very careful with that. But that reversal process, when it occurs, is very, very large. And so you just got to be aware of what that risk is.
So two things. One, to your point there, in terms of a risk of a price reversal, there is a tremendous amount of demand for gold going on right now, especially on sort of the institutional side. And we've had folks on this program recently, like Andy Scheckman, talk about just the massive flows of gold coming really out of the LBMA vaults in London to the COMEX here in New York. And a much higher percentage of futures contracts buyers standing for delivery of massive amounts of ounces relative to what they've done in the past. And so to your point, Lance, like that's supply and demand. Right now, there's a ton of demand in that area. And if that were to equilibrate, if that were to normalize, in theory, a lot of what's pushing the price up right now, could drop or go into reverse, right?
Yeah. And this is just a chart, by the way. So this is the continuous contract of gold. This goes back to 1976. The red lines are previous peaks where you've had both a very high correlation in the markets, extreme overbought conditions in terms of relative strength. But that's a monthly chart. So this moves really, really slowly, and very extreme positioning in terms of momentum. And, you're at records where this has previously, been a near-term peak in gold. And again, like I said, is like, when you get some type of process, you can go for a very long period. This was 2012 through 2020, that basically the price of gold went nowhere. So you can, and it, again, didn't collapse, right? You didn't have this massive decline in gold, but, it just was a very long time where you have an asset that produces no income and did not rise in price. And then that's okay. Again, that's a your decision thing. But if I could own a basket of stocks that are at least yielding a dividend, even if they go nowhere in price, I'm still making money on my money.
Yeah.
Right? And which is what my goal is ultimately, is always be creating money.
Yeah. And let me ask you this. I don't know the answer to this. I'm just tossing it out there. We saw a massive spike in inflation. We saw a massive distortion of the system. There was so much going on at the time, right? Could gold's run here over the past year just be a lag? Could it just be a lagged effect? Could it actually be reflecting the increase in inflation just on a delayed basis?
Again, it's rationalizing.
Well, I'm just asking the question.
That's what I'm saying. And so first of all, no, I don't have an answer for that.
Yeah.
And again, that's us. So whenever you say, why is this happening? And then you try to assign a reason to it, that's rationalization. So
yeah, I know, but you made the point earlier. Well, gold, it broke its narrative. It wasn't a good inflation hedge. And I'm just saying, could it actually be one just on a delayed basis?
Well, yeah, sure, but that's rationalization, right? And that, again,
so was your comment,
right? No. You missed my point. In 2022, it's just the price. The price was going down because more demand for selling than you had buying back in 2022. But everybody was trying to say, well, I'm owning gold because inflation's going up. I want to own gold, but it wasn't working, right? The rationalization was, I want to own gold for an inflation hedge, but it didn't work. That was the rationalization. And like I said, I just wrote an article this week about, using a Rorschach test, the ink blot.
The Rorschach, yeah.
Yeah. So, but that's the very basis of what we do. We look at something happening in the market, and then we base our whole thesis on why this is happening based on some rationalization, which tends to be wrong more often than it's right. And again, when we actually dig down into what drives stock prices or bond prices, a good example today, right? Bond prices right now, I'm looking at EDV, it's up, $1.83 today, 1.83%. And you just had a hot inflation print. That doesn't make, and you had collapsing consumer confidence today, according to the University of Michigan, because you had a spike in inflation expectations. That's not theoretically good for the bond market, right? So why are bond prices going up? It's supply and demand. You have more buyers today than you have sellers, probably because of, it's end of the quarter rebalancing for portfolios. But, the rationalization that high inflation should lead to higher yields isn't working today. So that's why we've got to be really careful. And that's the whole thing is I'm never anti any asset. Don't ever think I don't like an asset, because all I'm looking for is an opportunity where I can make as much money as I can over a period of time with the least amount of risk. That's all I'm looking for.
Yeah.
And if I can create income and a cash flow on top of that, that's even better.
All right. Well, look, I appreciate you doing this with me, folks. Hopefully you
Sure.
feel like I held Lance's feet to the fire here to get increased clarity on where he is. Lance, I think you've been very transparent and honest with us, so thank you. Hopefully
Sure.
everybody's happy. All right, I want to move on here just so we can lock everything in before we wrap up. Real quick, credit spreads. Anything notable going on there?
It had a little bit of an uptick, but that's not surprising, just because high yield bonds are very correlated to equity prices. So people kind of use that as a proxy for equity risk. So in other words, if I'm a 60-40 allocation model, right, and I've got to own 40% bonds in my portfolio, well, what I can do to try to juice returns is I buy high yield bonds in the bond sleeve of my portfolio because they're correlated to stocks. So if stocks go up, the high yield bonds go up as
Yeah.
well.
Kind of a way
It
to
works
cheat,
in
but yeah, you
reverse.
got it. Yeah.
It works in reverse. So that the fall off in or the de-risking of equities has also led to a de-risking in the high yield bond market. So you're seeing a little bit of you're seeing a very minor uptick in credit spreads between junk and investment grade. But once you get out of the junk market, bond yields are still the bond yields themselves, credit spreads really kind of across the maturity wall are still pretty suppressed. So you're
Okay.
not seeing a lot of concern.
I talked with Stephanie Pomboy about this earlier in the year, and kind of the analogy we came up with is credit spreads are like a body that was left for dead, and now you're seeing the leg twitch a little bit, right? So you're like, oh, wait a minute, maybe he's not totally dead yet, but he's certainly not getting up and running around yet.
Exactly. And again, there's again, this is the one thing that I just want everybody to really be cautious of. And again, if you're listening to this show, we talk a lot about stuff, and my whole message is always just simply be very careful about extrapolating really short-term things into some bigger context. You got to wait for the weight of evidence to prove, like we're having this correction right now. We're down about 9% from the peak. It's an absolutely normal correction
Right.
historically after 20% years. Don't extrapolate this into the next bear market until we have a real weight of evidence in our favor. Could we be going into a bigger bear market? Absolutely. Will we be taking actions to drastically reduce portfolios? Absolutely. But right now, the weight of evidence isn't there. Right now, we're just going through a very good, healthy correctional process in the market that if things play out normally, are going to lead to a very, very good rally at some point this year, just like we've seen previously. Even if it is the beginning of a bigger bear market, you're going to have a rally that will get markets back to overbought in the short term, and can use that to reduce risk. So again, just be careful with headlines and narratives and this need to do something, just because that typically doesn't work out well.
Okay. And we've talked about that an awful lot, but I don't think you can emphasize it enough. And maybe that was the answer to this question. This is the last question I wanted to ask you before we got to your trades. So clearly, this is a year defined by uncertainty and volatility, right? The question I had for you is, given your experience, Lance, what mistakes do you see folks make the most at times like this when fear starts to take over? And is that the number one? Is
That's it.
they leap to
It's
the worst and then they make
yeah.
radical decisions?
The things that we do worst as investors historically is that we go through kind of the basics of the biases that we have as investors. We start with loss aversion, right? I can't afford to lose any more money, so I've just got to get out. And so I get out of these assets, and then I go buy whatever asset's going up. And so I jump basically from the frying pan into the fire. So I get out of long stock positions and I start shorting the market, or I get out of one set of assets and I go buy I go buy emerging markets. I think that the people jumping into emerging markets right now are going to get their ass handed to them by the end of this year, because the economic growth in Europe is not recovering and they're very much on the verge of recession. And so a lot of this rotation that we've seen early this year from US stocks to international is going to reverse very likely. And I think probably sooner than later. And we're going to see that trade fail and money come back into US assets. That'll depend on the rally on the dollar. But these are those environments that we get ourselves into. Again, we go back in history. I mean, people have been talking about, oh, this is the year for emerging markets and international, like every year for the last 10 years. And it just has not been the case. Maybe this year is different. We'll find out.
Some year it will be, but yeah.
But the thing we do is we start trying to avoid losses by taking action. And then we wind up taking the wrong action. And then then the greed factor kicks back in. It's like, oh my gosh, now I'm missing out. I've got to get back in. So you start jumping back into assets just at about the time that the market really is going through a bigger correction. And we just kind of keep going back and forth. And this is why investors continually underperform over time, is because they're constantly jumping from one thing to another thing. And what defines success as an investor over time? And again, you look at Paul Tudor Jones, you look at Gerald Loeb. I just posted on our Substack, I did an article on Tuesday with Gerald Loeb's 12 investment rules. And you go back to any great investor over time, they have a set of rules. And if you look at the rules are not buy the dip, sell the rallies. It's not, buy and hold. There's not one great investor ever that promoted buy and hold as an investment strategy. They are very simplistic rules about managing risk, paying attention to what the markets are doing, watching price action, trading the price action, being aware of the risk, and managing that. And so have a discipline, which is the most important thing. And I don't care what your discipline is, but you should have a discipline that's written down. And if you can't write your investment discipline down, you don't have one. So that's a great place to start, is like write down your own 12 rules. Don't steal them from somebody else. Go write your own 10 or 12
You gave
rules.
people this homework last week, right? And I think a lot of people probably failed the test. Yep.
Yeah. And go write it down. And if you can't write them down, that's a great place to start. But once you have that kind of in your back pocket, then you're in a good position to start investing and managing your own money.
Well, so that's where I was going with this question, which is, okay, so if that is the sin that most people make, given just our human wiring, how can an advisor like RIA help people avoid that pitfall?
No, and that's a great question. Again, it's not just RIA advisors. It should be any advisor that you're working with or yourself. And again, we have, again, this is why it's also very important that you understand, is like when you and I are talking, Adam, I talk a lot about our portfolio model. It's like you asked me, like, Lance, what trades did you do today? Well, we did these trades or these trades. And that's generally in our kind of our 60-40 stock allocation, stock bond model allocation. That's just one model that we run. We run multiple different types of models for different investment strategies, different outcomes, different investor risk profiles, et cetera. Like I said, we have, like earlier we're talking about, we've got a portfolio that owns gold. It's very conservative. It's got some stocks in it. It's based on kind of the permanent portfolio principles. So we have that, right? That's something you can choose from. That's one of the vehicles that's on our car dealership lot. But you've got a lot of different choices in how to manage your money, but they're all driven by the very same set of investment processes and investment principles. And I think I talked to you last week about that we could look, and this is kind of what an investment process or a strategy looks like. And again, we talked about writing your own. And this is a great way to start, is to just look at, what's the active asset management approach built around, what's the design, what's its deliverables. We have a very set process for scanning for stocks. So doing equity selection, that we work through a very strict process to figure out what stocks we're going to buy or hold in the portfolio. The construction cycle of the portfolio is based on different market and economic cycles, whether it's we're in a market where value is outperforming growth or growth is outperforming value, whether we're in pre-recessionary or post-recessionary environments. That comes actually into the design of the portfolio weightings and how we do that. And then again, when we overlay those fundamentals and that sector analysis with the technicals to determine, because fundamentals tell us what to buy, but technicals tell us when to buy it or sell it.
Or the when, yeah.
right? But you can't dismiss, and this is why we were talking about gold earlier, right? So technicals, let's just talk about gold is a good example. Not picking on it, not hating it. We own gold, but technically extremely overbought. Fundamentals doesn't really have any, but we can just say, okay, fundamentals of gold are gold. But that reversion process, that's gold is so deviated that that reversion from the mean to the mean is eventually going to happen. Now, when's it going to happen? I have no idea. But we know that based on all the technicals and where they are, that fundamental reversion to the mean will eventually occur. And when it happens and what causes it, I have no idea. But that's why, as investors, we've got to be aware of that and then manage that risk within the portfolio. So again, just, if you own gold, don't be afraid to take some profits. That doesn't mean sell everything. But if your position in gold is 5%, it's now 6%, trim it back to 5%. Take a little bit of money, put it in cash. One of Gerald Loeb's investment rules is don't be afraid to hold uninvested cash. There's nothing wrong with that, because the goal of cash is waiting for the right opportunity to buy something cheap to where you can make money with it.
Yeah, it's optionality. Yeah.
Yeah. So buy discipline, have one down. So we got to buy discipline based on a variety of fundamental criteria, a fundamental set of technical criteria that get the buy in the process. Same thing on individual bonds and how we manage that exposure in the portfolios as well. Also have a very defined sell discipline. And we look at specific things on both fundamental and technical basis to determine when to reduce a position, sell a position entirely. Like recently, we just sold a position entirely in our portfolio because it just wasn't working. It violated several of our positions. And so we sold it. And so that's part of that process. And then we go through that so once you have that discipline and process, then you can move into a portfolio construction and evaluation process where you're running your existing positions against valuation screens, technical screens, and determining about where those are bought, sold, or held, or added to within the portfolio over time. So again, having, and again, this is rather long, but you get the idea, is that you've got to have, what we do in managing portfolios. Does it always work 100% of the time? Absolutely not. Does it mean we'll never lose money in the market? Absolutely not. Our portfolios are down a little bit this year, not nearly as much as the market, but they're down a little bit because markets are down and we're holding positions that are tied to the market. So it doesn't mean you're not ever going to lose money, but if you run this right and manage it right, you'll make money over time and you'll do it with less volatility and you can create income at the same time.
Right. And you have a process and a framework. It's not a gut feel. It's not reacting to an emotion. It's, hey, the process says this. Right. And over time, as you learn, you iterate and tweak, and hopefully the process gets better as time goes on. And it protects people from exactly what you were saying people tend to do in a fear-driven market environment like now.
Right.
Yeah.
And that's a good point, too, is that, yes, you can modify your investment process over time. That's okay. But you can't change it all the time, right? Because then it's not a process. If
Right.
you ignore parts of it today and accept parts of it tomorrow, or don't agree with I really want to buy this position, but everything in my process says don't buy it, but I'm going to buy it anyway. It's not going to work for you, right? You got to have the process and you have to follow it whether you agree with it or not.
Yeah. All right. Well, look, if you are a DIY investor and you were doing great during the passive era when, whatever you were doing worked great, but what you were doing now when you do it isn't working, maybe it means you need a new process. And so either construct one of your own, or if you don't have a clear idea how to do that, leverage somebody else's process here. All right, Lance, we got to wrap it up here or get close to wrapping it up. I do want to try to squeeze in the rant from last week that we didn't get a chance to do real quick. Trades. What trades, if any, have you guys made over the past week?
None this week. We are very close to instituting a short position in the portfolio to hedge the portfolio. That may or may not occur. We're waiting really to kind of get through Monday, to get through end of the quarter rebalancing, see what the market does. And then of course we've got that April 2nd, kind of Liberation Day. So we got some stuff kind of potentially that could, once we kind of get past it, if the world doesn't blow up, this market could rally pretty strongly. So I don't want to be short the market in that type of environment. So I'm really kind of looking for some confirmation here. We may be getting it on Friday again. Markets are down pretty decently on Friday, but again, that could reverse on Monday. So again, just we'll talk about this next week. But I mean, we are potentially getting close to hedging and starting to reduce some risk in the portfolio. And then, depending on how things go, we could get more aggressive about that in the next month or two.
Okay. So thinking about putting a short on, interestingly, though, just you said this earlier, and I forgot to mention it, we're still in a buy signal, right?
Yeah. Yes.
Okay. Still in a buy signal, but it could get invalidated. And certainly the way the markets are going, as we've been talking here on Friday, that could happen. You're beginning to think about taking on a short. You're not yet thinking about making a big change in the portfolio, right? Where you basically, you have your 25% increments where you're like, okay, we're going to cash with 25%. You're not considering that yet.
We're not there yet.
Yeah.
That signal's got a good ways to go. So you're going to need a lot more chop and grind to the market to get there. And I think there's a potential that we could see that this summer. But again, over the course of right now, there's just, the markets are still decently oversold on a little bit longer term basis. We're on a buy signal. Money flows are positive. Yeah, the market's really struggling here, but we're seeing some buying coming in underneath the surface. So I don't want to negate that too much. I don't want to ignore that. But if this market can't get on its feet, then we're going to have to start getting a little bit more defensive here near term. So again, just, we're trying to, this is one of those times where we're trying to just navigate very, very choppy waters.
Yeah. Yeah. And it's really, we really have to rely on your TA indicators here.
Yeah.
You put up a chart, it was maybe last week, showing that one of the reasons why you were sort of expecting the market to reach a tradable bottom was that as the market was going down, retail buying was growing, right? It was more robust. Is that continuing, or is retail buying starting to cool off here?
It cooled off a little this last week, and that's kind of not surprising. But there is still buying coming into the market. And again, we kind of saw this yesterday, even on Thursday, even though there was a lot of kind of pressure on the markets, there was a lot of buying intraday. We saw, the market would decline and you see a pretty strong kind of, strip of buying. And we've seen some buying coming in right towards the end of the day, which is kind of tends to be more institutional. So again, we're still seeing some positive buying pressure here. And the volume on the declines has been a little bit weaker. We're not seeing big surges in volume on the sell-off days. So again, that's a little bit encouraging, but that's kind of, hanging on to straws.
Yeah.
Again, we have to pay attention to the bigger risk profile out there, which is the market. And this failure at the 200-day and the break of this little uptrend channel, if it holds, is certainly not encouraging. So again, that's why we're being, starting to get a little bit more cautious here, because this is starting to look a little bit more like just a short-term correction. This may be turning into a little bit longer consolidation process, which again, it's not going to be fun.
Okay. All right. Well, look, as we wrap up here, if you remember, I introduced you as the exigent Lance Roberts at the start here, and exigency, just to remind folks, that's driven by a purposeful urgency. I actually love that word. It just means that you're really driven to just get stuff done. And I think I asked you this question last week when we turned the cameras off, and I was telling you about the rant I was hoping to get to. I think I'd asked you, how long do you think that the U.S. was in World War II? All right, do you remember the answer?
How long do I think the U.S. was in World War II?
Yeah.
Well, December 7th, 1941 to 1945.
Yeah. Yeah. So actually, from beginning to end, officially, less than 4 years.
Right.
And it's amazing when you see all the innovation that happened during the war, but certainly that came out of the war, that just transformed society, right? Radar, jet engines, computers, eventually the internet, synthetic rubber, rockets, helicopters, microwaves, the atomic bomb, modern communications, cell phones, et cetera, right? Just to name a few of them, right? All of that innovation was packed in just to less than 4 years, less than a single college time frame.
Well, part of that came during the space race, like cell phones, microwaves, a lot of that communication that came during the space race in the 60s.
They had mobile phone units during World War II.
Sorry?
They had, I don't know if they were radio, but they had mobile phone units during World War II.
Yeah. No, I'm saying, but a lot of the stuff you just named was also generated during the space. A lot of it came out of World War II. but then a lot of it was really innovated and expanded on during the space race. I mean, those,
Sure,
but the
absolutely.
point, yeah, but the point is that the point you're making is that both of those periods were extreme drivers of innovation over a specific goal where we united the whole country in a specific agenda.
Absolutely. And my point is we were able to accomplish a tremendous amount, way more than anybody could have
Yeah.
imagined in a shockingly short period of time,
Yep.
right? Um, and the lesson I want us to take from this is what is possible, right? So, we talked about a lot of reasons to be concerned about where things are headed in the future, and I'm trying to end here on a more positive note. And look, societally, it certainly can happen again because it's happened before. We have these proof points, right? And I think, and I'm not making a partisan comment here, I have no idea if they're going to be successful or not, but I think that's part of the spirit of the new administration. They certainly seem to be having some exigency about, hey, we want to make a lot of progress in a very short period of time. And they've got a lot of bold economic goals. We'll see if they are able to achieve those. In a lot of ways, we're crossing our fingers because we looked at those debt charts, right, of what could happen if we don't make big changes. But I mean, I will say again, not making a partisan endorsement here, but there's been some really impressive progress in a very short period of time. I think the administration's less than 2 months old still, right?
Yep.
And if you look at things like, border, right? Border security is big, right? So what? It's been a 96% decrease in border encounters. Um, they have, I think I heard since the new administration took over, they've captured three of the FBI's top 10 most wanted. Three folks are off that top 10 list. And I think it's been like 5 years prior, they'd captured zero, right?
Yep.
Yesterday, they just captured the head of for the East Coast, the head of MS-13, a big foreign gang operating here in the U.S. Um, so, they're putting wins on the board on the things that they care about, right? So they're just showing, hey, if we focus, right, and a lot of this is cross-discipline task forces that hadn't been assembled before. It's just a proof point that say, hey, if we come up with a priority and we all make it a big goal and we all focus on it, we can actually get stuff done pretty quickly. One of the things they're trying to do to, boost the economy and bring a lot of capital into the U.S. Is, yes, tariffs, but also using them to get companies to commit to making investments for capital investment here in the U.S. And I've got a quick list. This isn't even a comprehensive list, but let me just read it to you real quick, Lance. Bear with me 1 second. Okay, so it's companies and countries that have committed pretty substantial amounts of capital here. So you've had United Arab Emirates commit $1.4 trillion, Saudi Arabia, 600 billion, Apple, 500 billion, Nvidia, 100 billion, SoftBank, 100 billion, Taiwan Semiconductor, 100 billion, Johnson & Johnson, 55 billion, and then a bunch more, anywhere between a couple billion to 27 billion or whatever, Eli Lilly, Hyundai, Merck, GE. Again, who knows what's going to happen with all that? But that's a lot of a lot of capital and a lot of entities that have lined up to say, yeah, we're going to start pumping a lot more money in here than we were before. So look, where I'm going with this is, look, who knows if the new administration is going to be successful with this stuff? I wish them well. We need that big, changes in terms of curtailing our spending and increasing our growth. But we should look at this personally, right? And to say, look, if exigency on a national scale can win us, a world war, can get us to the moon. If I take a little bit of that goodness and apply it to my own life, what am I able to do, right? And I guess just the idea I want to put in people's heads is you are likely able to accomplish way more in the next couple of years that you imagine is possible right now. So, in terms of homework, last week's homework was from Lance was to go and try to write your own personal investing statement. And if you couldn't, then figure out how you were going to, find somebody whose statement you could leverage. I think my homework for you this week is just to lean back and dream for a little bit about like, what are the things that I would love to transform about my life? What are the force multipliers that I'd like to apply to my life? And just dream big, don't put any limits on it for a moment. And then pick a couple of those dreams and say, well, okay, what would it actually really take to get that done? And then try to say, okay, how can I put together an action plan to actually try to make progress on these things. And, you know, pick several things, right? Career-wise, skills you'd like to learn, health improvements you'd like to have, life experiences you'd like to enjoy, new relationships you'd like to build, you know, whatever it is that's most important to you. But if you pick 2 or 3 and, you know, put a big bold stake in the ground, you know, chances are, you know, if you're really serious about it, you're going to be able to inject a lot of that good transformative goodness into your life. And I can guarantee you this, to borrow the words from Michael Jordan, right? I guarantee if you don't do this, you're going to miss 100% of the shots you don't take, right? So Lance, you're a gentleman who I think in general in life sort of exemplifies exigency. So I'm sure you've got a couple of opinions on this.
Yeah, well, no, I mean, it's, you know, I was sitting there thinking while you were talking about, you know, what the current administration is doing. And I was just thinking, it's like, can you imagine that if we actually had conservatives and Democrats all working together, you know, with the power of AI and everything that we have in our country today, and you know, if we could all come together and just come to a common agenda and say, okay, our agenda is we're going to, you know, solve homelessness, we're going to cure cancer, and we're going to, you know, increase the economic productivity of the average American, right, and just try to fix this wealth gap. You know, if we actually all, if we could all come together and focus on and reduce the debts and the deficits, right, we could even work on that. But with the power of AI and everything else that we've got at our fingertips, you know, it would be astounding as to what we could actually probably accomplish and create within the country. If we just would say, look, forget everybody else, right? We're just going to focus all of our efforts on making America, you know, the best it can possibly be, the shining beacon on the hill, whatever you want it to be, with all the technology and all the power of smart people and companies that we've got here. It's, you know, what we could create would be absolutely amazing, right? But we just can't get on the same page. Everybody's just fighting for the sake of fighting. It's like, I just don't want to agree with Trump because I don't like him, so I'm not going to agree. All of his policies are bad just because I don't like him. You know, vice versa. You know, we're not going to agree with
Right,
anything
vice versa. Republicans weren't doing Biden any favors either
yeah.
as well. Yeah.
And so, you know, that's, you know, that's the issue. And it's unfortunate, but that's why we can't do anything, right? You know, we're
Yeah.
it's just, and we stay stuck in this kind of mill. But you know,
It's the old Pogo cartoon. We've met the enemy and he is us, right?
yeah,
We're our own worst obstacle here. Yeah.
yeah, exactly. And it's a shame. But you know, speaking about us, you know, just individually as people, you know, this is why it's so important. And we've talked about this before, is that, you know, if you don't have a goal, if you don't, and again, you know, no matter where you are, I'm almost reticent to tell you the story, but I was at the grocery store the other day and I was waiting in line. There was kind of a long line at the grocery store. And there was this 18, 19-year-old kid in front of me. And he was just complaining to his mother about how America sucks. And, you know, he hates it in America. And he just, you know, kind of wishes, you know, just wishes the worst out of on everybody. And I said, excuse me. I said, why do you hate America so much? And he literally just starts screaming at me. I mean, just at the top of his lungs. And I was like, hold on just a second. Just said, just hold on a second. You know, you're not trapped in America. You can certainly leave. And he starts screaming at me on top of his lungs. His mom's just standing there. She's like completely red. She's so embarrassed. And I'm like, look, I said, just take a breath for a second. I said, my son, when he was 18, he had a choice to go to the military or go to college. And he came to me and he says he was leaving the country, and he bought it. He worked a summer job. He bought a plane ticket and he left the country. He's been living overseas now for 6 years. He's doing great. He loves it. But it's no different there than it is here, because again, we can only make the best out of our situation as what we have. And he's like, well, I'm not going to college, you know. And I was like, that's your choice. You don't have to go to college. You can go to trade school and learn a trade. I don't want to do that. I don't want to work. And I'm like, okay, so what are you angry about? And and just start screaming at me at the top of his lungs. Now the whole store is looking at me, right? like, and I was like, just take a breath and hold for a second. I said, look, you know, I said, I know you're upset. I know you're angry. I said, you're 18 years old. You don't even know what the world is like out there. I said, you hear a lot on social media. You hear a lot of things in front of you that probably most of them aren't true. But the best thing you've got to do is that you've got to just figure out what it is that you want to do and start working towards a goal. And, you know, he just, at that point, he just walked out of the store and wasn't willing to listen. But it's just kind of that's the situation that we've all gotten ourselves into, is that we start thinking that our current station in life is what we're trapped in, and we're unwilling to do what's necessary to change our set of circumstances. And whatever our circumstances are, they're changeable. We just have to be willing to either take the risk or put in the effort or put in the time, or a combination of all of the above, to change those circumstances. And it may not work out. It may not turn out as we expect, but that's okay too, because we learn from that failure and then we try again. But this is the same thing that occurred. I mean, the first time they tried to make the atomic bomb, it didn't work, right? It's just they didn't just throw some stuff together. It's like, okay, there it is. Go,
Right.
go drop the bomb. It took tests. It took failure after failure after failure. It took test after test after test, and you created the most horrific weapon ever known to man. Probably would have done better without that, but that's the point. Anything that you want to do in life, how many rockets did we try to send up in space that didn't make it, right? Even when we got people into space, things went wrong, and we learned from failure. And now we've got some Yahoo that created a private company that's going up to rescue people off the International Space Station. So, it just goes to show you that anybody can achieve an outcome, but it's going to take failure. It's going to take effort. It's going to take education, and it's going to take time. And nothing's going to happen overnight. The richest people in the world, it only took 10 years to get there, right? I mean, it takes time and effort to achieve a goal. You just got to be willing to commit to it.
Well, what you need is a healthy dose of exigency, right?
Yeah.
This purposeful urgency of, hey, I'm going to get it done. I had a couple of experiences recently. They may make their way into future rants. But I had a very good old friend come this weekend who very tragically lost a child in an accident. It was really just terrible. And
That's terrible.
she's doing about as best as you can, getting on with life after that. But she'd be the first one to tell you that, we don't have infinite time, right? There's a lot of wonder and a lot of beauty that we can create in this life, but it's not going to happen on its own, and we're not going to be here forever, right? So you need, this exigency of saying, look, I got to get started sooner rather than later, and you want to inject it with excitement, which is, hey, look, it's pretty awesome if we go out there and build a bunch of rockets and a lot of them blow up, but we learn more every parts along the way, and at the end, we're going to the moon and we're rescuing people off of space stations and we're thinking about going to other planets and expanding human consciousness. And that's just one example, right? So anyways, we'll wrap it up here, folks. But the call to action here this week is to look at your life, dream bigger than you do normally, and then ask yourself, what can I do to dial up my exigency to try to create some of these dreams and make them realities in my life? If you think one of the best ways to make a big dream of yours a reality is to continue to watch Lance Roberts on this channel, everybody's biggest dream, I think. Let them know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. If you want to take some exigency in your financial life, and maybe, especially if what you're doing is the old playbook that's not working so great right now, you want to leverage somebody else's process like Lance was talking about. If you've got a good financial advisor who you're just not working enough with, great, lean into that relationship. But if you don't have one and would like to, talk to one of the ones that Thoughtful Money endorses, perhaps even as Lance and his team there at Real Investment Advice, then consider scheduling a free consultation with them by going to thoughtfulmoney.com, filling out the short form there, and the firm that you get matched with will be in touch with you right away. All right, Lance, look, another great week. Glad you're back in action. It was funny, a couple of times this week, I was thinking to myself, did Lance leave on vacation? Because the market's doing really poorly.
Yeah, no, this week started out well and, ended up, started out with a bang and ended with a thud. So we'll see how this turns out next week.
All right. Well, no matter how it turns out, you'll be here making sense for us, with everybody. Lance, thanks so much. And everybody else, thanks so much for watching.